Hey guys, today we're going to go over the all-important topic of your credit score, mainly what affects it, how we use it as lenders, and why we use it. Okay, important to note that there are three types of credit bureaus: Experian, Equifax, and TransUnion. Today we're going to be focusing on Experian, or your FICO score, the one that a lot of people know. Okay, again, I'm Matt McDonald from Premier Mortgage Lending. Let's start this up. So to start, I'm going to kind of go over the broad range for your credit scores. Okay, and I'm not going to go over each individual one, but I am going to go over some important numbers with it. Okay, roughly, again, these are all kind of rough estimates, but anywhere from a 780 to an 850 is considered an excellent credit score. If you're in that category, you're going to get the best interest rates possible, you're going to get the most lenient financing, and you are part of the most qualified borrowers that a lender could have. Okay. Another important number to note is 680 to 719 is what's considered average. Okay, so a lot of people have been asking me, what's the average range that people are in? According to the Experian website, 680 to 719 is that average range. And then the last number that I'm really going to focus on is 620. Okay, if we need your credit score at least a 620 to be able to lend to you. When I say we, I don't just mean Premier Mortgage Lending. I mean mainly any other lender that you're going to go through, whether it's an auto loan or a mortgage, anything that you're going to apply to get money. You're going to need a 620, or your rates, if they do accept you, are going to be through the roof. You're going to have a ton of fees that are in there. Okay, so that 620 number is really something that you should aim to get above. Obviously, the higher the better, but again, that's like that bottom, that floor number that you should be aiming for. Okay. Next, we're going to go over the 5 major things that affect it. Okay, these are crucial. The first one is going to be your payment history. Second one is going to be credit utilization. Third one is going to be the length of your credit history, so how long you've had like a credit card or any sort of credit account. Fourth is going to be new credit, and 5 is going to be the types of credit. Okay, some of them are more important than others, and we're going to go through each individual one now, kind of nitpick what's important out of it and how we can actually improve your credit score with each one. Okay, so the first one is payment history. This roughly makes up about 35% of your credit score. This is by far the most important one. Okay, with this, it's crucial to make on-time payments. Okay, creditors want to know that they are going to get their money back. So if they're going to lend to you, they want to make sure that you're going to make your payment, because if not, they're not going to make their money back. Imagine if you were loaning money to somebody, you would want to make sure that you're going to get that money back. Okay, with this, there is some recency bias to this, and what I mean by that is, let's say 5 years ago you missed a payment on your mortgage. They won't take that as harsh as if last year you missed a payment on your mortgage. Okay, so the more recent that missed payment is, the more it's going to affect your score. So it is something that it can kind of be worked out. That doesn't mean it's going to be a stain on your credit report forever, but again, it's crucial to make your payments on time with that. Next is going to be credit utilization. Okay, with this is about 30% of your credit score. Okay, so again, credit utilization and payment history make up about 65% of your score. That's just showing you where the credit bureaus are favoring. What credit utilization is it measures the amount of debt you have versus the amount of available credit that's available to you. So for instance, let's say you have a credit limit on a card of $10,000 and you use $5,000 of that credit limit, your credit utilization is 50%. Okay, so again, just for that example, just to show you some numbers there. Ideally, this number is 10% or less. That would put you in the excellent category for the credit bureaus, but anything under 30%, again, roughly give or take there, is generally going to be considered good. Okay, you start creeping over 30% credit utilization, your score is going to start getting hit relatively hard with that. Again, they want to make sure that just because you can be lended $10,000 doesn't mean you're just going to go ahead and use all $10,000. They want to see that you're smart with your credit. Next is going to be length of credit history. This is about 15%. So again, there's a pretty big drop off between this one and the first two. With that, just because you have a short credit history doesn't mean that they're going to penalize you if payments are made on time. Okay, payments on time are more important than the length of your credit history. So just maybe because you're 19, you just opened a credit card doesn't mean you're going to start with a 550 credit score because you just opened your card. Make your payments, your score is going to really start going up really fast. Okay, next is the new credit. What that means is how many accounts have you applied for? How many times was your credit pulled? Okay, they take this into consideration because if someone is applying for many credit cards over and over and over again, there's probably an indication that the cash flow situation is not very good. Why would you need to keep applying for credit cards if you have cash on hand to pay for things? Credit bureaus see that as a red flag. With this, okay, I've mentioned this in previous videos, just because a lender pulls your credit doesn't mean your score is going to go down 20, 30 points. Okay, if we pull your credit for a mortgage, let's say, it's going to maybe go down 2 or 3 points. This is about 10% of your score. So again, this isn't a huge factor, but it is a factor to take note of. Lastly, we have the types of credit used. They do want to see a mix of credit. They don't want you just having like 15 credit cards and that's your credit. Okay, this can be divided up between credit cards, mortgages, auto loans, department store cards, etc. Again, this is a very small percentage of your score, so don't go out and just apply for credit apply for different types of credit just because you want to raise your score. This is about 10% of the score, so this is a very, very small factor. But again, nevertheless, it is a factor for your score. Next, we're going to go over why is credit so important. Okay, credit determines your financial stability and just your ability to be lended to. Okay, if you have a higher credit score, you're going to get better interest rates, and you pose as a lower risk of a default. Okay, if you have a lower credit score, according to lenders, you pose as a higher risk of default. Okay, so if you have a lower credit score, you're a more riskier borrower, so you're going to get higher interest rates to make up for that. In contrary, if you have a higher credit score, you're going to get lower interest rates because you are seen as less of a risk. Okay, credit is very, very crucial to being able to buy a house, get a more credit limit on your credit cards, and then even just interest rate on an auto loan. Okay, credit score is huge. You want to get your credit score as high as you can before you go through any of those processes. Okay, lastly, here, we're going to go over how to improve your credit. Okay, there really is 3 big things. First one is pay off your credit cards. That should be what I feel like is relatively self-explanatory, but to really dive into that more specifically, you want to pay off your cards that you're using a high credit utilization with. So if you have a card, let's say that has $1,000 on it and you're using all $1,000, you want to pay that card off first before the card, let's say you have $5,000 limit and you're using it for $1,000. Okay, those $1,000 are treated very differently by the credit bureau, so that is important to know. Okay, pay off your cards and pay off the ones that you're using a high credit utilization of. Next is you can apply for higher credit limits. Just because the credit card that you're with gave you the starting credit limit, that doesn't mean that you have that limit for life. You can apply for higher limits, and that will actually raise your credit score because now you have more available credit and you're seen as somebody who's more responsible that doesn't need to use all that credit. Okay, and lastly is keep your credit cards open. What I mean by that is even if you're not using that credit card, you haven't used that card in 5 years, do not close that account because now your credit limit has actually been dropped. Just keep it open. Even if you're honestly paying an annual fee on it, it's actually probably going to be worth it for you because again, you have higher available credit, which is what the bureaus want to see. If you guys have any more questions about the credit score, why we use it, how we use it, feel free to drop a comment below. Feel free to comment on either Facebook or Instagram. Make sure you like, subscribe, comment below. If you have any suggestions on videos that you want to see, make sure to put them in the comments. I'm open to any and all suggestions. I want to help you guys out as much as possible and give you guys the content that you want to see. So again, comment below anything that will interest you, anything that you have questions on, and we'll make sure to make a video on it. Make sure we post it everywhere to help you guys out. Again, my name is Matthew McDonald. My number is 603-475-5471. Reach out if you have any questions or if you're looking to apply or refinance your home. I'd love to help you guys out.